If you are a Canadian senior and you file taxes, this new CRA rule could quietly cost you money. And the problem is, most seniors have no idea it even exists. This is not about penalties or audits. This is about money you could be missing out on simply because the CRA changed how they handle certain information, and they did not make it easy to find. My name is Mr. Maple, and I focus entirely on Canadian tax rules, senior benefits, CPP, OAS, GIS, and CRA updates that affect retirees. Everything I cover comes directly from Government of Canada sources, CRA guidance, and official publications. Today, we are talking about a CRA rule change that rolled out quietly. It affects how certain income is reported, how certain deductions are applied, and how some seniors could accidentally trigger clawbacks or lose benefit amounts without realizing it. This is not a scare tactic. This is information you need to know so you can protect yourself. If this sounds useful, go ahead and like this video right now. It helps YouTube show this content to other Canadian seniors who need it. And if you are not subscribed, hit that subscribe button. I post weekly updates on CRA rules, tax changes, and benefit programs for Canadian retirees. Let's get into it. What is this new CRA rule? So what exactly is this rule? Starting in the 2024 tax year, which means it applies when you file your taxes in 2025, the CRA changed how they require certain income sources to be reported on your tax return. Specifically, they updated the reporting requirements for foreign pension income, certain investment income, and income from part-time work or freelance activities. Now, you might be thinking, I don't have foreign income. I don't freelance. This doesn't apply to me. But here is the problem. Many Canadian seniors do have income sources they do not realize fall under this new rule. For example, if you receive a pension from the United States, the United Kingdom, or any other country, even a small one, this affects you. If you earn income from renting out a room in your home or from occasional consulting or part-time work, this affects you. If you receive interest income from foreign bank accounts or investments, even if it is a small amount, this affects you. If you withdrew money from a foreign retirement account like a U.S. 401k or IRA, this affects you. According to CRA guidance, the new rule requires more detailed reporting of these income sources. You now need to include specific identification numbers, foreign tax amounts, and country codes on certain lines of your tax return, and if you do not report it correctly, the CRA may automatically reassess your return, which can trigger clawbacks on GIS, OAS, or other income-tested benefits. Here's what makes this even trickier. The CRA did not send out a major announcement. They updated their forms and guides, but many seniors do not read those carefully. Many seniors use the same tax preparation routine every year, and they assume nothing has changed. So, if you filed your 2024 taxes the same way you filed your 2023 taxes, there is a chance you missed this new requirement, and if the CRA reassesses your return because of missing or incorrect information, it can result in a reduction in your GIS payments, a clawback of OAS benefits, interest charges on unpaid taxes, delays in receiving your refund. This is not about doing anything wrong. This is about a rule change that was not communicated clearly. Why haven't most seniors heard about this? So why have so few seniors heard about this? There are a few reasons. First, the CRA does not send individual letters about rule changes. If you go to the CRA website, you can find updates buried in tax guides and forms, but unless you are actively looking for changes, you will not see them. The CRA assumes that everyone reads the updated guides every year, but realistically, most people do not. Second, many seniors use tax preparation software or hire someone to do their taxes. And while that is helpful, not all software programs automatically prompt you for the new information. Some do, but some do not. And if your tax preparer is not up to date on the latest CRA changes, they might file your return the old way without realizing it. Third, the CRA updated multiple forms at once. They changed parts of the T1 General Form, the T4A OAS form, and several schedules related to foreign income and investment income. If you are not familiar with tax forms, it is easy to miss these changes. Fourth, this rule change was not headline news. It was not covered widely in the media. It was not announced on TV or in newspapers. It was quietly rolled into the CRA's annual updates, and unless you follow CRA bulletins closely, you would not know it happened. And here is something most people do not realize. The CRA does not always catch these mistakes right away. Sometimes it takes months or even a full year before they reassess your return. By that time, you may have already received benefit payments based on incorrect income information, and when the CRA corrects it, they can ask for that money back. So, even if you filed your taxes months ago and everything seemed fine, you could still be affected by this rule down the road. If this is making sense so far, please take a second to like this video and subscribe to the channel. It really helps more Canadian seniors find this information. Who is affected? Let's talk about who is actually affected by this rule. You are affected if you receive any pension income from outside Canada. This includes U.S. Social Security, UK pensions, pensions from European countries, or retirement income from any other country. You receive investment income from foreign sources. This includes dividends, interest, or capital gains from foreign stocks, bonds, or mutual funds. You withdrew money from a foreign retirement account. For example, if you worked in the U.S. and you are now withdrawing from a 401k or IRA, this affects you. You earn income from rental properties, freelance work, or part-time consulting. Even if it is just a few hundred a year, the CRA now requires more detailed reporting. You have foreign bank accounts with more than $100,000 CAD in total. The CRA requires you to report these accounts separately, and the new rule tightens how this is done. Now, here is a key point. Even if your foreign income is tax-exempt under a tax treaty between Canada and another country, you still need to report it. Just because you do not owe tax on it does not mean you do not have to report it. For example, many Canadian seniors receive U.S. Social Security benefits. Under the Canada-U.S. tax treaty, you may not owe Canadian tax on that income, but you still need to report it on your Canadian tax return. And the CRA still uses it to calculate your net income, which affects your GIS and OAS eligibility. This is one of the most common mistakes seniors make. They think, I do not owe tax on this income, so I do not need to report it. But that is not correct. The CRA wants to see all of your income, even if it is not taxable. And here's the costly part. If the CRA discovers unreported foreign income, even if it is tax-exempt, they can reassess your benefits going back several years. That means you could be required to repay GIS or OAS amounts you already received. So even if your foreign income is small, you need to report it correctly. How this can become a costly mistake. Let's talk about how this rule can quietly cost you money. Scenario 1, GIS clawback. The Guaranteed Income Supplement is income tested. That means the amount you receive depends on your total income. If the CRA reassesses your tax return and discovers unreported income, your GIS amount could be reduced or eliminated entirely. Let's say you did not report a small foreign pension of $5,000 per year. The CRA finds out during a reassessment. They recalculate your income and determine that you were not eligible for the full GIS amount you received. Now you owe back several months of GIS payments, potentially thousands of dollars. And here is the worst part. The CRA does not just reduce your future payments. They can ask you to repay past payments immediately. Scenario 2. OAS Clawback Old Age Security is also income tested, but at a much higher threshold for 2024. If your net income is above approximately $86,000, you start paying back some of your OAS. If your net income is above approximately $142,000, you lose OAS entirely. If the CRA reassesses your return and adds unreported income, you could suddenly cross that threshold and trigger a clawback you were not expecting. Scenario 3. Interest and penalties. If the CRA determines that you underreported your income, they can charge interest on any unpaid taxes. They can also charge penalties if they believe the error was due to negligence or carelessness. Now, to be clear, most seniors are not trying to hide income. They are simply unaware of the new reporting requirements. But unfortunately, the CRA does not always distinguish between honest mistakes and intentional errors. So, even if you made an innocent mistake, you could still face interest charges. Delayed refunds. If the CRA flags your tax return for review because of missing or incorrect information, your refund can be delayed by weeks or even months. For seniors living on fixed incomes, a delayed refund can cause serious financial stress. So the bottom line is this rule might seem like a small technical change, but it can have major financial consequences. What many seniors don't know, let me share some quiet details that most Canadian seniors do not know about this CRA rule. Detail number 1, the CRA cross-checks your tax return with foreign tax authorities. Canada has information sharing agreements with dozens of countries, including the United States, the United Kingdom, and most European nations. That means if you receive income from one of those countries, the CRA already knows about it, even if you do not report it. So, if you think the CRA will not find out about your foreign pension or investment income, you are wrong. They will. It is just a matter of time. The CRA can reassess your return for up to 3 years after you file. That means even if you filed your 2024 taxes and everything seemed fine, the CRA can still go back and reassess it in 2025, 2026, or 2027. And if they find unreported income, they can ask for money back. Detail number 3, if you receive a notice of reassessment from the CRA, you only have 90 days to dispute it. Many seniors receive these notices and assume there is nothing they can do. But if you disagree with the reassessment, you have the right to file an objection. You just need to do it within 90 days, or you lose that right. Some tax preparation software does not automatically update for new CRA rules. If you use the same software every year and you do not update it, you might be filing your taxes based on old rules. Always make sure you are using the most current version of your tax software. Detailed number 5, the CRA has a phone line specifically for seniors. If you are confused about how to report certain income, you can call the CRA and ask. The wait times can be long, but it is free, and the agents can walk you through the process step by step, what you should do right now. So what should you do if you think this rule might affect you? Step 1. Review your 2024 tax return. Look at every line where you reported income. Did you include all foreign pensions, foreign investment income, rental income, and part-time work income? If not, you may need to file an adjustment. Step 2. Check if you received a notice of reassessment from the CRA. If the CRA already reassessed your return, you need to review that notice carefully. It will tell you what they changed and why. If you disagree, you can file an objection within 90 days. Step 3. Gather documentation for all income sources. This includes foreign pension statements, investment income statements, T5, T3, or foreign equivalents, rental income records, receipts for part-time work or freelance income. If you do not have these documents, contact the organizations that paid you and request copies. Step 4. Use the CRA's online tools. If you have a My Account login with the CRA, you can view your tax return, notices, and benefit payments online. This makes it much easier to track what the CRA has on file. Step 5. Consider working with a tax professional. If your situation is complicated, especially if you have foreign income, it may be worth hiring a tax accountant or consultant who specializes in cross-border tax issues. Yes, it costs money up front, but it can save you thousands in the long run. Step 6. If you made a mistake, fix it as soon as possible. If you realize you did not report income correctly, do not wait for the CRA to catch it. File a voluntary adjustment using the CRA's online adjustment tool or by mailing in a T1 ADJ form. The sooner you fix it, the lower the interest charges will be. And here is something important. If you voluntarily correct an error before the CRA finds it, they are much less likely to charge penalties. Common misunderstandings. Let me clear up a few common misunderstandings about this rule. Misunderstanding number 1. I do not owe tax on my foreign income, so I do not need to report it. Wrong. Even if your foreign income is tax-exempt under a tax treaty, you still need to report it. The CRA uses it to calculate your net income, which affects your benefits. Misunderstanding number 2. The CRA will tell me if I made a mistake. Not always. Sometimes the CRA reassesses your return without contacting you first. You only find out when you receive a notice of reassessment in the mail. Misunderstanding number 3. This only affects people with a lot of foreign income. Not true. Even small amounts of foreign income, $100, $500, $1,000, need to be reported correctly. Misunderstanding number 4. If I use tax software, it will handle everything automatically. Not necessarily. Tax software is only as good as the information you enter. If you do not tell the software about your foreign income, it will not include it. Misunderstanding number 5. I am too old to deal with this. The CRA will not bother me. Unfortunately, the CRA does not make exceptions based on age. If you owe money or if you received benefits you were not entitled to, they will ask for it back regardless of your age. How to avoid this mistake in the future? Here is how to avoid making this mistake in future tax years. Tip number 1. Keep detailed records of all income sources. Do not rely on memory. Keep a file, physical or digital, with all income statements, pension documents, and investment records. Tip number 2. Read CRA updates every year. Yes, it is boring, but the CRA updates their tax guides every year, and those updates include important rule changes. Spend an hour reading through the guides that apply to you. Tip number 3. Use professional help if your situation is complex. If you have multiple income sources, foreign income or rental properties, hire a professional. It is worth the cost. Tip number 4. Set reminders for tax deadlines. Do not wait until the last minute to file your taxes. Give yourself time to gather documents and review everything carefully. Tip number 5. Check your CRA, My Account, regularly. Log in at least once a month to check for notices, reassessments, or benefit changes. The sooner you catch a problem, the easier it is to fix. Tip number 6. Ask questions. If you are unsure about something, call the CRA. Yes, the wait times are long, but it is better to wait on hold for 30 minutes than to make a costly mistake. Why this matters? Why does all of this matter? Because for Canadian seniors living on fixed incomes, CPP, OAS, GIS, and small pensions, every dollar counts. Losing even a few hundred in benefits because of a reporting mistake can be devastating. And the frustrating part is that this rule change was not communicated clearly. The CRA expects everyone to keep up with their updates, but the reality is that most seniors do not have the time, energy, or technical knowledge to do that. That is why videos like this exist to translate complicated government rules into clear, simple language that real people can understand. You have worked your whole life. You have paid taxes. You deserve to receive every benefit you are entitled to. And you should not have to worry about losing money, because the CRA changed a rule and did not tell anyone. So, if this video helped you, please like it and subscribe to the channel and share it with other seniors, your friends, family, neighbors who might be affected by this rule. Before we finish, here is a quick disclaimer. This video is for informational purposes only. It is not legal advice, tax advice, or financial advice. The information is based on current CRA guidance from the Government of Canada. But tax rules can change, and every person's situation is different. If you have specific questions about your taxes or benefits, contact the CRA directly or speak with a licensed tax professional. Do not make decisions based solely on this video. All right, let's wrap this up. Here is what you need to remember. The CRA changed how certain income must be reported on your tax return. This affects seniors with foreign pensions, foreign investment income, rental income, or part-time work income. Many seniors have not heard about this rule, and it can quietly cost you money through benefit clawbacks, interest charges, or delayed refunds. If you think this rule affects you, review your tax return, gather your documents, and fix any mistakes as soon as possible. Now, here is what I need you to do. First, like this video. It helps YouTube show this information to more Canadian seniors who need it. Second, subscribe to the channel and turn on notifications. I post new videos every week on CRA rules, CPP, OAS, GIS, and senior benefits. Third, leave a comment below. Tell me which province you are watching from, whether you are retired or still working, and if you have ever dealt with CRA reassessments or benefit clawbacks. I read every comment, and your input helps me create better content. And if you know someone, a parent, grandparent, friend, or neighbor who could benefit from this information, please share this video with them. You could literally save them hundreds or thousands of dollars. Thank you so much for watching. Stay informed, stay protected, and I will see you in the next